Today, we are going to talk about two books that I think most Canadian business owners, entrepreneurs, investors either have read or will read, as they are highly influential books for wealth building. And today, we want to talk about those two books and maybe a slightly different take than what you may be expecting. But that's what we're talking about. So let's get into it, and let's not beat around the bush here, Kyle. Let's dive right in. What would you say is the first book that you've read, and also, we think like most Canadian business owners will read or have read, and you're not, also would say like you should read this, but you also should read this thinking about this way or that way. Let's get into it.
Yeah, so these books today that we're going to talk about. I mean, there's a ton that we've chatted about, and we hope to chat about in future discussions here. This one's a little bit of a curveball because it's really designed for the average North American. Really, anyone around the world could dig into this one, but I think it's a really important one for people to get a sense as to sort of how you can become rich. And actually, that's the title of the book. It says, "I Will Teach You to Be Rich" by Ramit Sethi. And actually, he's got a Netflix series where he does a bunch of case studies and they go through. And a lot of times it sort of starts, in my opinion, on more of like the Dave Ramsey path, right?
Yeah,
so, but slightly different approach. He's more open to spend money how you want, feel good with money, like you're making money so that you can utilize it and spend it. So really like the mindset there. But sometimes when he talks about the actual wealth building approaches, sometimes the parts that I think, on paper, they work. He's a big index investor, an advocate for, hey, listen, you budget to pay yourself first by taking a certain amount of money, putting it into typically index funds and letting it go. He also is sort of an anti-advocate for the use of, say, advisors, like wealth advisors, for example,
Waste of
right?
money.
They take fees, and, mutual funds have high fees, and they, and if you do the math, right, like these are calculations you can do, and it makes perfect sense that yes, if you put money into index funds, if you do things that way and you pay less in fees, you're actually going to be better off in the long run. But the part that we want to talk about here today, so first of all, great read, worth looking at. But the part that we want to kind of highlight here is sort of the tough part about actually doing what he's suggesting here. And that is taking a certain chunk of money and actually putting it in for the long term into things like equity funds, whether it's a global equity fund, S&P fund, whether you're a Canadian investor, TSX, whatever you believe in, to actually put it in there, continue to contribute to it every year, and then leave it pretty much until you're ready to hit that financial freedom number. On paper, the math makes perfect sense. The problem and the challenge that I want to sort of expose here about doing something like that is that oftentimes behavioral economics and the research around what we do and behaviorally how we act as humans is oftentimes quite the opposite, and really in two ways. The first one is being able to actually commit as much money as you possibly can to making that investment decision, because once you say buy to that money, you're saying buy for a while, and usually it's a long while, and that oftentimes can hold people up, especially earlier in the journey, right? Earlier in the journey, that money, you're thinking, what if something goes wrong? What if I need that money? What if I have to pull that money back and the market pulls down? Or the second issue that I have, which again, very, very, behavioral economics focused, is that we often do boneheaded moves at exactly the wrong time, right? So in my mind, I'm going to put money in there, I'm going to let it go. And it's like, yep, I've got a 20-year horizon. Maybe I've got a 15-year horizon. Maybe I've got longer. But then that market starts to dip. And actually, as we're recording this today, the market is dipped. It's dipped 1% today. And like, I look at that, and even though I know and I'm confident I don't need the money that I have invested in the market, it still makes you go, I wonder if it's going to dip more. Is it going to come back tomorrow? Is it going to be next week? Is Trump going to talk about tariffs? Like, what's going to happen here? And oftentimes we make poor choices. So with that particular book, something that I want to highlight here today is that oftentimes when we put together our strategy, sometimes the most rational strategy that we can use often is not necessarily the easiest to actually implement in reality. And therefore, we
Right.
recommend that people start looking beyond just a simple one sort of hit wonder approach to your wealth building strategy, as you'll understand through our 4-stage process.
Yeah. Yeah. Like I think what you're hinting on here, right, is that even though the book helps you create a pathway and it gives you a clear step-by-step approach in a way, and I do love the very specific budgeting aspect of the book to specifically say, like, in order for you to be rich and to use, say, and invest these funds that are above and beyond what you really need to live, you get to decide what that budget looks like. If and his famous one is like, if you think living rich now is having your Starbucks coffee every morning because that's what you really value, then put it in your budget.
Right.
But then make sure that you're choosing other things so that
you're already there.
You're
already rich. He's saying, right? Like,
that's
like,
what his big
made
message is. And I think that speaks to why we would say, like, make sure you read the book, because it's like, that speaks to, in a way, our first phase of a healthy wealth plan, which is really knowing what it is that you're after. What do you want your life to look like now? What do you want your life to look like later? What are the numbers that you need to know? Which means you got to know your budget. You got to know how much you're spending. How much you're going to want to spend later. Like, I really like that part of the book. But I think what you're saying here is that it's like, even though he's going to teach you how to be rich, and here's the pathway to exactly be rich, which actually reminds me a lot of another book called The Simple Path to Wealth by J.L. Collins. Very similar messaging, very similar structure of book, same lessons, says index funding is the way to go. But what you're getting at is like, I will teach you exactly the right pathway, but following the pathway, you're going to fall down. Like you're not going to get there. And it's like this. It's like we've used this analogy here on the show before, is that already the pathway to, like, be healthy. It's just like, I can exercise daily, get my 20 minutes of vigorous exercise every single day, eat right, but so many people can't do that. And everybody knows that that's exactly the path. It's like, but we still can't follow it as a society or an individual to stick to that pathway. It's like, Ramit's like, I will teach you the pathway, but then there's no guidance on how to do it, which what we're saying is like, okay, follow the pathway, but what you need to realize is his pathway actually is setting you up in a way for failure, because he's not working in how to account to make your mind be okay with following the pathway, which in our opinion, you're missing the stage 2, the phase 2, which is like your wealth reservoir, and making sure your wealth reservoir, which other people call that an emergency fund. We don't call it an emergency fund anymore. We call it our wealth reservoir because it's our opportunity fund. It's our emergency fund. It's very flexible.
It's our fixed income bucket too. It's our safety bucket.
Yeah, it allows your mind to be like, that pathway that Ramit's talking about makes sense now, because I can now developed a system and a plan, and I've got this tool or this fund that is allowing me to sleep better at night.
Right. Well, and something that's interesting. So budgeting, obviously, whether it's personal or on the business side in your corporation or both, is a really helpful thing that can help you feel more comfortable with the amount of money that you do put into your investments. One of the biggest hiccups that I see in these types of plans, where we go, like index funds, set and forget, Psychology of Money as well, another great book. He sort of articulates the same messaging, right? Like, just get the money in there. Don't be a captain stock picker. Don't try to be a hero. Just do it. The problem is that when people are deciding how much money to put in, it's always easier when it's like the extra money in your budget, but not just the extra money. And what I mean by just the extra money is like, that's the money that you're like, but this month might be a little bit more expensive than last month, right? Like, we might do something different. That's my cushion. So taking that extra cushion for people, they don't put it into the market. If you don't put it into the market, then you're not going to get that same result that, seems so simple and easy, right? It's like, if I always know that I don't need $1 above blank, whatever is in my budget, it's much easier to do. But here's the thing, even then, like, even if you're an amazing budgeter, it's hard to take all the rest and put it into something that is supposed to go off for quite a long time. So I'm going to use an example of RRSPs for a second. A lot of people don't utilize their RRSPs even when they should, like even when they're in a really high tax bracket, say a T4 employee that can't control the income that's coming in. They're like hesitant to put as much as they probably could put into the RSP because they see it as like, I say the high security prison. That money goes, it's going to grow and it's going to be helpful at some point down the road. But you're like, but what if in 2 months from now, I change my mind and I want to do something or I want to buy something and maybe I don't want the cup of coffee. Maybe I want the car. Maybe I want these are all things that go in our mind. So what do? We wait. Paralysis analysis. And the big challenge that I see happening, and I want to flip to the business owner side in a moment here, is that we have a lot more money sitting doing nothing because of this analysis paralysis than doing something with it. So what's really important here is like when we look at average rates of return, and we always use numbers that are lower than what the actual S&P returns. Why? Because the vast majority of investors actually don't get that number, not just because of fees, but also because of bonehead moves, how long we put the money in, when we put the money in, all of those types of things. So if we said like 8% is like a nice average rate of return, but we're not putting all of that additional money in, we're not going to get the same result that you might anticipate when we look at a spreadsheet, right? And we say, hey, listen, we're just going to put this much money in and get 8% a year. What we see on the business owner side, because they've got additional risk in the fact that most of their chips are in their business, right? Their business is where most of their wealth lies. They often are not as willing to put in as much of that extra chunk that I was articulating a moment ago because they're more concerned about what ifs. What if the invoice doesn't get paid on time by the client? What if the tariffs mean that I'm going to have less income or less revenue completely? What if? There's so many what ifs there. So a lot of times what we'll see with business owners, they have a significant amount of, say, retained earnings, but they're usually sitting in a checking or maybe even a savings account. Sometimes they'll toss it into a GIC, but it's like a 90-day because you're like, 3 months, I can get my hands back on it. Yeah, exactly. So it's like if you take all of that extra money and you were to follow Ramit's plan and you put it into index funds, in 20 years from now, you're going to be like, wow, like that was amazing. But the problem is that behaviorally, we're unable to do so. Why? Like fight or flight. Like we're like, oh my gosh, I don't know what's coming next. And that's where our wealth reservoir idea, whether I'm a unincorporated, T4 business or employee, or whether I'm an actual incorporated business owner, there is a place, there is a lane that we feel that people should be putting money into what we call that opportunity fund. And it starts usually as like a savings account or, something fixed income. But as you start building out your quote unquote portfolio, I would much rather see anything that's in the market goes into those equities, whether it be global, whether it be a split of US, the NASDAQ, TSX, whatever it is. Like do those things with the extra money. But the rest of that money, you treat as your fixed income, safety, conservative, liquid, accessible money bank, which we call the opportunity fund or the wealth reservoir. And for us, as that bank grows, it does make sense to transition from something like, say, a checking or savings account that's going to get taxed into something like, say, a high early cash value permanent policy to only replicate or use as a bucket for those funds. We don't want to see money coming out of the market. Like Ramit would say, no, you don't take money out of the market. 100% we agree. But for that portion that could go in the market, but you're unwilling to put into the market or into real estate or into Bitcoin or into gold bars that you're going to bury in the backyard, like whatever it is for you that you're not willing to do, those dollars, you can be so much better off by optimizing, growing it, and then keeping that liquidity there so that, hey, you might hit a certain point in the journey where you go, I'm ready to start putting more into those growth opportunities. What do we do at that time? We start to leverage that bucket because we're feeling safe And for me, I'll be honest, I will teach you to be rich. It's not about Starbucks every day, like Ramit saying, like, does that make you happy? What makes me happy is knowing that I am financially secure. I have growth, but I also have safety, because who knows what's right around the corner. People are talking about housing bubbles. They're talking about the stock market bubble. We know there's a bubble. The question is, when's it going to pop? I don't know. It could be next year. It could be 10 years from now. I don't know. So I want to get the upside, but I also want to be ready for when that does eventually happen, because it's not an if, it's a when, so that we can then pounce and also feel like, hey, my lifestyle isn't actually going to be negatively impacted. Mind you, my mindset will still hurt because I don't like to see number go down. But if and when it does, I know that I've got enough healthy enough bucket here that I can essentially do whatever it is, whether it's Starbucks or backing up the truck and putting it right into that market.
So we would recommend you read I Will Teach You to Be Rich by Ramit Sethi. But when you read it, if you've not read it, you could go read it, but then come back here and re-listen to this episode, because you'll want to re-listen to this after you've read it to go, oh yeah, right. I need to build that part of my plan so that I can feel truly rich. Okay, 100%. Let's get into the second book that we have read, we highly value. And the second book that we would highly recommend, we've read, we've taken a lot of value from. We would encourage all business owners, Canadian business owners, entrepreneurs, investors to read this book. It is definitely needs to sit in your tool belt area, is Becoming Your Own Banker by R. Nelson Nash. In this book, I think if you've heard of this book, you've read it, you've probably also ventured down the infinite banking tunnel. And the idea that of becoming your own banker is to eliminate the banking system inside of your own family or your own networking, so that you have flexibility, you have freedom from, doing whatever you need to do. You want to buy a car, you use your own banking system. If you want to invest in something, you use your own banking system. You want to lend a family member some money, you use your banking system. If you set up this system, which is what the book teaches you, then you never have to go and ask somebody permission to use money that you could technically have access to without that permission. The book talks about high cash value life insurance as that tool to use, which we just referenced as our tool that we use for our wealth reservoir. We use this tool all over the place in our wealth planning system. And I think this book has some great analogies to read. Now, one of the stories I remember hearing about this book, or when I was reading this book, is basically saying, like, you've got, let's say you use a high cash value life insurance policy, you start setting up premiums, you've got that high cash value, the cash value that's attached to it, that you say, I now have this as my opportunity fund, and I can leverage against that to go and make a purchase or pay a bill or invest in, say, real estate, which we've talked about many times here on the show. And I think the lessons I think most people remember from the book is to say, like, okay, you can do that, but don't forget that you've set up a business. Your business is like a store. It's like the IGA down the street, and it's got things on the shelves, and it's like when you take the peas off the shelf, that's like you borrowing money from your business. And you're going to then use those peas or eat those peas. And the lesson is, don't forget to pay the peas back. Like, put the peas back, which is important. Like, if you have this tool, a high cash value life insurance, to leverage that tool and use the leverage to go and purchase real estate, you have to have a plan to pay back the fund so that you can do it again and again and again. And this is where the infinite banking idea comes from, is that you have an infinite source of wealth if you continually pay the premiums and you continually replenish your funds so that you can continually make two uses of the same dollar. And I think that makes sense. However, I think where a lot of people read this book is that they read this and say, like, I have to follow this exact plan, which means I have to take my peas from my store, and then I'm going to make sure I pay those peas back. But I think the big idea here we want to kind of make sure that we call out is that sometimes you don't have to take your peas. Sometimes you could use the peas down the street, because the peas down the street may be cheaper. But you get to use your peas as collateral to get the peas down the street, which means maybe taking a policy loan from the now co-owned insurance company that your policy lies at may not be the best option for you at that time. Maybe getting a third-party lender could be an option for you in your business or your personal side because it makes sense mathematically. And I think sometimes when we read books like Becoming Your Own Banker, we get so ingrained in like the lessons they really want to teach, when sometimes it doesn't make sense. So while it's important to have a plan to pay back the P's, you need to realize that don't get sucked into just that's the way we have to do it.
Yeah.
Always have like you got your strong convictions, but like loosely hold them. Like think about what does it make sense. The P's down the street might be I can lend money or I can borrow money down the street cheaper to actually accomplish the same goals I have and have a plan to pay back because I have collateral sitting over here in this jar. And so we want to be, I guess the idea here is that the book is so important to read to allow you to have the freedom and really maximize the use of your wealth reservoir. But you also must want to be critical and have plans around how to reach your goals. And I think that's the big lesson I think I want to kind of pull here from this book.
Yeah, you brought up quite a few things, and I think one thing that is really easy to maybe, I don't want to say miss because it's not missing. It's almost like it's almost like you dig in a little bit too much, where sometimes people will read that book and then they sort of think like every dollar of, remember, the extra money, the money that we were going to invest needs to be in a policy, as if the policy itself is going to like be the thing to create wealth. In reality, like that's not really what it's going to do, because that would be, again, rates of return are going to be pretty similar to like a GIC, right? In terms of the cash value. So, I mean, unless that's the type of investor you are, that could definitely work, right? If you're super conservative and you don't like risk at all, then sure, like pretty much zero risk, no volatility, access to cash, all of those things. But we have to just always take things with a grain of salt and say, for us, it's the optionality that we really appreciated. And I wish, when I go back, it was probably 15 years ago when I first stumbled across this idea of the infinite banking, concept. And I read that book and I did a lot of research. I ran numbers. I didn't really do anything because I was sort of like not exactly sure. Like I was under the impression that I should be funneling like all of my additional capital towards a policy. And I think that's what actually held me back. Had I understood at that time that the money that I was sort of keeping to the side for my wealth reservoir, we didn't call it that back at that time, but if I was funneling those dollars in, I would be in a much better position had I done that back then, right? Because those dollars weren't really accomplishing a whole lot. They were keeping me safe. They were allowing me to continue investing where I wanted to, but I wanted to keep a certain amount of liquidity. And I could have accomplished that thing with that particular tool. So that, to me, is not made clear in that book and in many other books like it. It almost gives you, they don't explicitly say take every dollar and do that. But I think it's the message that a lot of people get when they walk away from it. Now, only when you and I started running into our retained earnings issue did I circle back to this idea. Because then when I recognized that death benefit pays out, the net death benefit will pay out of a corporation through the capital dividend account without any tax. That's when like the alarm bells really went off for me. And then I dug back in and I did way more research. And then I recognized that, oh my gosh, this thing like is now a no-brainer because we're incorporated, because we have retained earnings. This is something that I could do to accomplish all of those things. We still use similar rules of thumb. That money that we want to have available in liquid, we want to flow through a policy. The only difference is now it's inside of a corporation. Had we not gone down that path, I may never have revisited this strategy at all. However, I now recognize that I could have used it first for my emergency fund and then for my opportunity fund. And then one thing that we're seeing a lot of individuals and business owners really like gravitating towards is then thinking about, when I figure out what is my income, my fixed income to equity ratio. Oftentimes they usually put equity first. So the equity to fixed income ratio. So if you're like a 60%, 40% investor, if that's who you are, that 40% is a fantastic spot for it to go is into what we call our wealth reservoir tool, the high early cash value permanent policy, because it has the liquidity, it has zero volatility, which is massively helpful. And we're able to essentially achieve similar rates of return to what I would have been doing anyway with a 60-40 without any sort of drawdown risk for that portion of the portfolio. Now, the same is true whether you're like a 70-30 investor, 80-20 investor. So our stance is like when I start zooming out and I think about it, when we go to like Ramit's book, we think about I Will Teach You to Be Rich. The assumption people get is like 100% equities, but then nobody talks about the extra money, not the extra that we're willing to invest, but the bucket that we're not willing to invest or willing to lock in for 20 years. When we think about becoming your own banker, everyone thinks it's 100% fixed income and then that's going to make you rich, or that I can leverage that and do something else with it. These things are extremes. And what we're saying is like, imagine if you figure out, and this is what we help our clients to do, is we try to help you figure out where do you fit. We had a client, I was on the call yesterday, $1 million of retained earnings inside the corporation, and they have basically $900,000 of it in cash, like sitting in cash in a high interest savings account. Sure, they're earning a little bit of interest. They're losing 50% to passive income tax. And over time, they'll actually grind away their active income small business tax credit. Like these are challenges. And when we look at that and we go, listen, first of all, I don't think you should only be 10% exposed to the market. We got to get that number up. That's going to take time and confidence. But for that other chunk, whether it's a 50-50 mix or a 60-40 or whatever they land on, we have an opportunity, a fantastic opportunity in order to make sure that we can get similar returns, similar outcomes based on the spreadsheet with limiting risk on one side of the portfolio while also keeping 100%, not quite 100, 90% liquidity, but also 100% liquidity if we do turn to third-party lenders. If we go down the street and we borrow the peas from somewhere else, we have access to more of that cash value and that liquidity. So for me today, two big takeaways is like, reading and getting these different perspectives is huge, but always remembering after we need to zoom out and we need to make sure, first of all, sometimes the author doesn't intend for us to take what we took away from it, right? So like sometimes they didn't mean for you to think that like every dollar's got to go into an equity index fund, but that might be what was interpreted, right? So we have to zoom out and we have to look in and go, okay, how does this fit for me? Where do my dollars lie in front of me? And is there a way for me to be able to optimize while also creating a little bit of extra safety for myself so that I can still accomplish a very similar goal, or maybe even the exact same goal, maybe even a little bit sooner? And that, to me, I think is the big takeaway here, the secret sauce for today's episode.
Yep, good summary there. Those two books, again, I Will Teach You to Be Rich, Ramit Sethi, and Becoming Your Own Banker. Our takes on those two books. You should read them, but then you want to take our lessons away so that you don't have to weed through the waters like we did after reading those two books. Just a reminder, if you want to learn more about the 4 phases, the 4 stages of a healthy wealth system, you can head on over to CanadianWealthSecrets.com/pathways. Take our assessment there. You will see which of the 4 you are the strongest in and maybe some recommendations on what to do to strengthen the others. The other call to action here is we help our clients. We help Canadian business owners and entrepreneurs strengthen those 4 areas up inside their business, inside their personal lives. So reach out to us. You can book a discovery call at CanadianWealthSecrets.com/discovery. One more reminder, Kyle Pierce is a licensed life and accident and sickness insurance agent and the president of corporate wealth management here at Canadian Wealth Secrets.